Good evening, everyone. For those of you who don't know me, I think I know everyone here though, but I'm Chris Rusing, been with Logan for about 11 years now, and I'm going to be presenting on this operations and GL posting. I'm excited to show this just because I think mainly for a lot of the supply chain consultants, sometimes people get in the room with some accountants, and it's not easy to understand what they're saying. I'm hoping I can bridge the gap on what they're trying to relate to and speak some kind of accountant language. So the agenda for today is first we're going to go over just basic accounting concepts, a little bit of a accounting crash course, accounting 101, just so you guys can get up to speed on that. And then for the business use cases, we're going to go through all the inventory based ones, the big three is what I'm calling them. We're going to start with purchase order processing, go to production processing, and then sales order processing. I know a lot of people in here also do promotion testing, right? A lot of the times when you're doing promotion testing, we're looking at those financial vouchers. A lot of that will be covering in this presentation as well. Then we're going to review configuration, some of the key configuration, and we're going to demo these transactions in D365, take a look at all the vouchers, and then we'll have time for Q&A at the end there. To kick it off, we're just going to go over some core accounting concepts. The number one rule, I would say, in accounting is that debits equal credits. So essentially, this concept ensures that every transaction remains in balance. So whenever D365 says you're out of balance, that means that either you're missing an account on the debit side or you're missing an account on the credit side, because D365 does not allow you to post an out of balance transaction. So for accounting, that means that debits will always equal credits. It means that there's always at least two sides to every financial transaction, one side being a debit side and one side being a credit side. In D365, debits are always shown as positive numbers, and credits sometimes are shown as negative numbers. Debits are always on the left and credits are on the right. And sometimes when you look at vouchers in D365, you can actually see that, how a debit will be shifted to the left and a credit will be shifted to the right. So we'll see that when we go through the demo. Another thing I want to harp on here is that every ledger account or main account has what we call a natural or normal balance for each type. At any point of time, if you go ahead and you look at the trial balance and you look at one of those accounts, the balance of that account should be in its natural balance for the most part. The normal balance or natural balance of assets are debits. An example of these would be your cash, your accounts receivable, inventory, and property, plant, and equipment or fixed assets. If you ever looked at the trial balance of any of those accounts, you would see a debit balance there. Assets on the balance sheet represent something that has value to the company. Cash is obviously valuable because it allows you to purchase material, pay your employees. AR, accounts receivable, that indicates money that will be paid to you by your customer. So obviously there is value in that as well. And inventory is also valuable because it represents the inventory that you will sell to your customers. So these are all considered current assets or short-term assets, as they're likely to be consumed or converted to cash within the year. Property, plant, and equipment, this is better known as like a long-term asset. So they're not going to be converted to cash within a year or for many years. And then moving on to your credits exist on the balance sheet in two forms. And the normal balance of these liabilities and equities are credits. So anytime you see a liability with the term equity, you would assume that the normal balance of those are credits. So liabilities, this represents things you owe or have an obligation to pay. like assets, you have current liabilities. So you can either have current or long-term liabilities. A current liability would be something like accounts payable. So that's something you're expected to pay within a year at the most. And then you might have something like taxes payable. You would also pay that within the year. You also might have long-term liabilities. So this is something like a loan or some form of a financial instrument. And then ending this, equity is the representation of the ownership amount in the company. In simple terms, if the company was liquidated, which means we sold all their assets and we paid off all our liabilities, the equity would be the portion left over. Equities also have some accounts that represent the value of what the company is profiting from a holistic standpoint. So one of the main points I want to point out is retained earnings. This is explained more on the next slide, but essentially whatever's left over when all your revenue comes in and you have all your expenses out, that's essentially what your retained earnings is. Another example of equity accounts would be stockholders' equity or common stock dividends. Dividends are a little bit different because they're actually debits to retained earnings. That is the way in which companies would pay out to employees of the company. Does anyone provide an example of either a debit or a credit, or I guess an asset or a liability or an equity account that they've seen before, seen other companies use before?
Petty cash.
Yep, cash. Yep.
That's an asset.
Yep.
A current asset.
Yep. Another example of an asset would be maybe like a money market account or something like that. A lot of times companies keep on their balance sheet something like a money market account, not exactly what they have in cash on hand, like what it represents their bank account, but some other kind of investment account in which they're investing money. Okay, so we're going to move on. Continuing with these basic accounting concepts, the other one that we've established, just the general concepts between debits and credits, we're going to go into some basic equations. So I feel like there's really kind of two equations you need to know, and this explains most things. Whenever you're thinking about an accounting transaction, I think it's helpful to think about these equations and think about how it will balance. And the first being assets equals liabilities plus equity. As I explained before, debits always equal credits, and assets have a natural balance of debits, while liabilities and equities have a natural balance of credits. Therefore, it can always make sense to say assets must always equal your liabilities and equity. And this serves as your basis of a balance sheet reporting. So when you think about a balance sheet report, this is what we're saying. We're saying our assets equal liabilities and equity, our debits equal our credits. The next equation to review is revenue minus expenses equals net income. So this is another concept in which sometimes people call this your net income or profit and loss. For profit and loss accounts, the natural balance of the net income really should be a credit, because credit is the natural balance of revenue accounts and debit is the natural balance of expense accounts. So you're hoping that your credit is greater than your expenses, and that would get your net income. When we're selling things, we would hope that whatever we're selling them for is more than what we produced them or bought them for. As a note to when you're doing your demos or doing whatever, right, you want to make sure that revenue amount is more than your expense. That means we're turning a profit, right? Our revenue exceeds our expenses, which will give us our net income, which will make sure that we have a credit balance for that net income. Just a note into like how the income statement pulls into the balance sheet is that your net income is actually transferred to retained earnings. When we close a year in D365, that's what we're doing. We're transferring our net income amount into our retained earnings amount, which goes into as an equity account, right? Your retained earnings is an equity account. That is your credit there in your balance sheet account. Any questions before we move on about any of the accounting concepts I went over? Okay. Now we're going to get into our business use cases. We're going to start with the purchase order processing. And I went over these just because I feel like these are the ones that I was trying to think of it from a supply chain consultant perspective. What are the ones that you guys deal with most often? And so these are the ones I feel like these ones make the most sense to go over. Obviously, there's more beyond this, but this should be the bread and butter for what we would expect, any kind of supply chain consultant to be leading a design session or something like that. They should understand some of the accounting on the back end of this too. So to start here, I go over the flow. Each of these business use cases, I'm going to go over a flow. And what I'm going through from an example standpoint are pretty simplistic. Obviously, there can be different variations and flavors of how you actually do this, but for the most part, I'm going to try to keep this as consistent and simple as possible. You create your purchase order, create your purchase order lines. Let's say you register items on the purchase order lines. These boxes right here, I have it highlighted in yellow gold. These represent steps in which financial transactions are happening in the system. For D365, when you generate a product receipt, we would expect a financial voucher to happen as well. When we post a purchase order invoice, we also expect a financial transaction to happen as well. What do those financial transactions look like? This is what we call T accounting, right? So you can see the T right here. This is my accrued purchases account, and I have my inventory, my raw inventory ledger account. So at product receipt, what happens is that we will credit accrued purchases. This is also called received on invoice or purchase accrual. From a inventory posting type perspective in D365, it's called purchase, accrual. And then from an inventory raw perspective, when we hit the receipt, we have cost of purchase materials received. And this is our inventory account. This is our asset account because this is inventory. Inventory always represents asset, right? What happens when we invoice it? Kind of the first thing what happens is that we have a reversal on the inventory side and on the accrued purchases. So we debit accrued purchases and we credit the inventory. And then the second part of this transaction is that we debit the inventory and credit accounts payable because we owe the vendor the money, right? For the most part, these accrued purchases, inventory, this all comes from the inventory posting profile. AP, this comes from the vendor posting profile. So this is where we say the vendor subledger, where does that payable live for that vendor? So I wanted to ask the audience, and this can be confusing at times because it's like, why do we have all these in and outs, right? We go in and accrued purchases, we go out of accrued purchases, ends up being a $0 balance. And then we have essentially a $1,000 balance because the receipt and the invoice is reversed out. I'm wondering if someone can explain why inventory is debited, credited, and then debited again. And really what I'm looking at is like, what is the purpose for following these steps as it relates to inventory costing? I'm wondering if anyone can provide any insight to that.
Chris, is that because we get an accurate inventory value earlier on during receipt and what
Ding,
the
ding,
PO
ding.
is?
Yep, exactly. So essentially, when we're in this step of doing a product receipt, back up, this is just what we're buying it for. This is what we think the price is, what we're purchasing for. And that might be coming from either a standard cost, the cost, or maybe we have a trade agreement set up. However, when we receive the invoice, that invoice amount might be different than what we actually thought we purchased it for. So maybe the invoice is more than what we thought the cost was for or less than. In this example, it's the exact same, but there's an opportunity that it could be different. And that's the reason why D365 does that, because it allows you to update your inventory costs at the same time paying the vendor the right amount of money that you owe them. Dave, you got your hands up?
Yeah, Chris, I have a quick question. You had mentioned the term subledger when you were talking about this.
Mm-hmm.
Can you give maybe someone who's in operations, maybe a better definition of what a subledger really is?
Yes, I'll give it a try to explain it. A subledger represents essentially one main account represents, in this case for AP, right? We have an AP account. This is a ledger account that usually is, let's say it's 2000. If you look at your vendor aging, you should see the same amount in your vendor aging as what it represents in your trial balance for that same account. From our inventory perspective, inventory is a subledger, AP is a subledger, AR is a subledger. So all of those have their own subledger reporting, from inventories, inventory value report, AP vendor aging, AR customer aging. Those values on those reports should match and reconcile against what's in the GL.
Good explanation. Appreciate it.
What do we have at the end here? Our final totals is essentially that we have an asset, inventory, raw material that we debited, and then we credited our AP, our liability, right? This is a debit, normal balance is a credit, our debits equals credits, assets equals liabilities, everything's in balance. Our impacts, we have our assets that we've acquired. So we have a debit to our balance sheet, but then we have a liability that we also have on the books because we have to pay that vendor. So we have a credit there. From that perspective, right, we're debiting and crediting both on the balance sheet. We're maintaining balance. There's no impacts from the account statement or income statement at this point, but we could, if we had like a charge on the PO or something that was hitting an expense, then that's possible that could hit the income statement from that perspective. Okay, so moving on. So we're doing production order processing. Again, the flow, these white boxes indicate no financial vouchers. The yellow represents financial vouchers. So we create our production order, we schedule operations or our jobs, and then we release that order to the floor. And then we're going to pick raw materials. So this is our picking list that we create, and we pick that raw material. And then we post either a route or a job card for any work that needs to be done to, put the finished good together. We report as finished. This gets our physical inventory. And then we end the production order. And then this will give us our financial end to the production order. So it's about to get really confusing, but because that's how production orders are. But essentially what I have right here first is our pick. The first two accounts here are our picks. So working with the same material, right? We have raw material. That was 1,000, right? So we picking that raw material. So we're crediting that inventory raw material account, right? Because the natural balance of that is a debit, which means we do have inventory. We're crediting it because we're taking it away. And what we're putting that into is what we call WIP. It's usually classified something like an asset on a balance sheet because technically it represents inventory in the process of being made into a finished good inventory. WIP material is still an asset, but we're crediting, we're debiting, we're in balance here. And then we have our route or job card. And what we're doing for this instance, I'm just using a route. We're crediting labor. This represents essentially a liability of something that we have to pay our laborers, whatever the work they're doing. And we debit that into WIP labor. Again, anything that's WIP related, it's an asset. It relates to something that we're creating the items. Things will go into different WIP accounts. Typically, what you want to see this go into is a specific WIP labor. I think it's better to keep it separate because then you have an understanding of what's your WIP material and what's your WIP labor. From a GL posting perspective, this all could be the same WIP. It just gets a little confusing because you'll just have a bunch of in and outs going to the same account. We got this represents our wages payable to workers. And then this is the WIP labor, which again is an asset that will eventually go into the finished good amount. Then we have our report is finish. The costing of this item is $1,100. What we're going to do is actually credit the WIP material $1,100, and then we debit our finished good inventory at $1,100. This is all still estimated because at this point, we don't really know happen in terms of, okay, were our numbers accurate, right, in our production order? Was our material updated from a costing perspective? Was the route card accurate with whatever the cost of the labor was, right? Essentially, the report is finished represents an estimated, and this is what actually D365 calls it, an estimated manufactured cost. That's what report is finished really means. It means we do have the material on hand, so we could pick it and use it against a sales order, but it's not the final cost of the item. So you can see the two end transactions, the two $1,000 right here, they get reversed out. Essentially, what we have is a debit to the inventory raw, and then the credit, which reverses what would happen on the WIP material. We have our labor, same kind of concept. It just reverses against what happened in the WIP labor. And then essentially what happens is we move out of the WIP material and WIP labor, and we move it into a WIP clearing. This $100 right here is actually a debit to this WIP labor over here. And then this $1,000 over here is actually the credit is right here to this WIP material. And then it moves out of WIP clearing to the inventory finished good. And this looks really confusing. So what I did is I put together this beautiful sheet. So we have our pick, right? Credit debit, $1,000. We have our route, $100. And then we have our report is finish, which is WIP material, inventory finished good. And we end the production order. What the ending of the production order will do is first it will reverse each one of these transactions. So it says reverse the pick. And then in the same kind of vein in which the purchase order, that final invoice might be a different amount than what we originally received it at, we get the true cost of materials consumed. The true cost of materials consumed is still $1,000. And then that goes into our WIP clearing. Reverse the labor, and that goes into our labor manufacturing cost absorbed, and debits also WIP clearing. And then we reverse our report is finish. So basically you can see like this orange, yellow, orange gets reversed, blue, green gets reversed, and then the red, pink gets reversed too. The gray right here, G1 and H2, these are the transactions that actually determine what our manufactured cost is between saying, in this instance, it's really simple. We just have two areas in which we have costs coming in. It's the cost of materials consumed, hitting that WIP of $1,000, and then also the labor, the manufacturing cost absorbed. What was the labor that was put into it? That's $100. Finally, 100 plus 1,000 gets us 1,100. We credit WIP clearing one more time, and then we debit inventory finished good, and that's our final manufactured cost of what represents the finished good amount. So I know this is a lot to look at, but I think this is, to me, the simplest way to understand what exactly happens. Does anyone have any questions? Christian, yeah.
What confuses me, it makes sense for the most part, but what confuses me is why you use WIP material for two different types of transactions. So you use it for cost of materials consumed, but also for manufactured cost.
This one really could be WIP finished good material, and this one could be WIP raw material. I think if you wanted to split it up, you could. They're both material, right? So I just kept it the same. But yeah, it's a really good point. You could separate those out so they are separated from a WIP perspective. Okay. So what do we finally get when we do our production order processing? We have our inventory, raw materials, we credit that asset account because we use that inventory. And then we also have a liability because we had some labor, some wages payable. We owe the people on the shop floor whatever their wages are. I was talking about this with Kate recently. Usually this is like an estimated number. If they are using the MES system where they're actually tracking how many hours they're putting into building whatever they're putting on the floor, then that might be very accurate. But for the most part, people don't do that. So this is more of a, hey, we think this is how much they owe, but that can be reconciled against what is actually coming in from payroll. So that's just a note there that unless they're having truly accurate times, then it might not actually reconcile. So there's our liability count, and here's our assets. So our final inventory finished good is hitting that debit there. So again, debits equals credits, and the I represent what's normal balance. Oop, I backed up right there. So any questions on this piece? I think between these two slides, this kind of really makes it all make sense, but yeah. Okay. Our impacted financial statements, really what we're doing, and I don't know, the way I look at it from the financial perspective, we're converting a raw material, which is an asset, to a different inventory account, a finished goods account, which is also another asset. And then we have the labor, which represents the wages payable to the people that produce the item. So this would usually be represented by a current liability on the balance sheet. Again, like I was talking about with Kate, usually what you would do is debit this from the payroll. This would come in from the payroll. And then in this instance, we also do not have any income statement transactions related. The only thing that we could have is related to this is the payroll transactions that come in against that. So you would have some kind of salaries expense or something like that. Okay, so finally we have our sales order processing flow. Again, this is pretty simple, but creating the sales order lines, picking the items on the sales order, and then generating the packing slip and posting the sales order invoice. Again, these two will be ones in which we have financial vouchers for. And that's why they show up in our T accounting. So when we ship or post our packing slip, it's really the posting the packing slip that does this. We credit our finished goods, right? The one that we just produced, it was $1,100. And then we debit COGS, our cost of goods sold. Again, this is our asset account that we're crediting. COGS is a expense account. So we're getting into the income statement side here, but COGS represents an expense account. Next, when we invoice, again, we reverse what we did on COGS and reverse what we did on finished goods inventory. Because a lot of the times, right, we might be producing an item, and once it gets wrapped, we say, okay, go ahead and pick it and ship it. And the packing slip gets posted. But what happens maybe after you end that production order, but you've already shipped it out, right? So if we end the production order before we invoice it, then we would have a situation in which maybe that amount would be different right here. So the inventory would be updated for the correct cost that was used, deducted from inventory, and then the COGS would be updated as well because the cost of the inventory changed, right? And that can go either up or down. And then finally, what we have here is our accounts receivable. Again, this represents a subledger to the customer, and then our revenue. This is just revenue account. We're crediting that, and we're debiting our accounts receivable. This represents the cash we will receive once they pay. And then if we look at our full amounts here, we have our asset credited, our COGS debited, that's an expense account. We have our revenue account credited and our asset account debited. If we're just looking at this from a perspective of our revenue, right? We have revenue of $2,000, expenses $1,100, right? So we had a net profit of $900. Eventually, what we do is we close these revenue and expense accounts, and whatever amount left over goes into retained earnings. Any questions on sales order processing? Oh, sorry, wait, let me just go through this. So in sales order processing, we have a couple impacts on both balance sheet and income statement. From a balance sheet perspective, we have our inventory account that is credited as we are taking our finished good inventory out of the system. We also have our AR balance, as that is an asset being debited, which represents our customer balance. On the income statement, we debit our COGS, as this is our expense, and we credit revenue, as that's our profits, giving us that margin, which you can just quickly see it's the difference between your revenue and COGS. And again, that's transferred to retained earnings at the end of the year to add to the equity balance, which equity is on the balance sheet. Okay, any questions before we go into configuration? All right, so let's go into configuration. The one first thing I want to talk about is the item model group. This determines how the inventory is costed, and it also determines partially how the ledger integration piece. So when are we actually posting to the ledger? So if we want to post physical inventory to the ledger, so that's at product receipt for purchase order, that's when we're reporting as finish for production order or doing the packet slip for a sales order, we want that post physical inventory to yes. There are actually instances in which companies, for whatever reason, don't want that turned on. So if they don't want any physical inventory being posted at time of physical update, then you would have that click to no. You don't have to have post financial inventory because that's what happens when you invoice or end the production order. One other thing is that we have the accrue liability on product receipt. When people say, oh, we want to do an accrual, that's that purchase accrual that received on invoice. When we want this flipped to yes, this gets a little bit different depending on sometimes what you're purchasing. Some people want to accrue for items. Most of the time they want to accrue for items used for your raw material that's used for production orders. But let's just say you're buying a laptop or something like that. A lot of times they don't care to know if they want to accrue for that or not. If they're doing a purchase order for something like that. So it's not always necessary for something like that. AR parameters, this is post packing slip and ledger. And then we have the AP parameters, post product receipt and ledger. Both of these represent the physical part, that physical update. So you have to have post physical inventory set to yes, and also both of these parameters set to yes to make sure that you're actually going to post something at product receipt or packing slip posting. And then production parameters, we have the post picking and ledger, which means when we post that picking list and we're deducting inventory out, that we're going to post that to a ledger account. And then report is finished in ledger. Obviously, that will represent part of the posting physical inventory. And then we're going to go through the inventory posting profiles for each one of these. Dave, you got a question?
I guess when we're talking about configuration, we mostly want those set to yes, unless the client has specific requests. Is that a good rule of thumb? Okay.
Yeah, I would say so. And I would say if anyone's doing promotion testing, all of those should be set to yes as well. I think a general rule of thumb is that we would want to see financial vouchers for each of those transactions. So this is the posting profile for a purchase order. This side actually represents my finished good item group, and this is my raw material item group. Really, the only difference you can see here is that I have a different main account for my raw material and a different main account for my finished good material. So this is when we receive it, what account are we hitting? When we invoice it, it should be the same account. Our purchase accrual, received on invoice, same difference. I have this purchase price variance. Variance accounts are only related to the costing methodology of standard costing. I actually, in my environment, I have standard costing set up. It's because I think it's easier. So I have variance accounts set up for all my posting profiles. Moving on. production order. So this is our finished good production order. If we had a cost of materials consumed, whipped, right, we can make this a different account here on the inventory posting profile compared to the raw material, which for me it's the same, right? I have this 150-100, or sorry, I think it's actually this estimated cost of manufacturing cost whip right here. Either way, it's the same account for either the raw or the finished good. As you can see, these are all really just asset accounts, right? Because we're just moving inventory from their natural account to a whip account and then moving it to the final manufactured cost. So we have our variance accounts. I want to point out, these are all actually our expense accounts. So for standard costing, anything that's outside of the norm of what the cost should be, it just gets expensed. And that's the natural balance for any kind of variance account as an expense. And then we have our sales orders. So again, we have our finished good and raw material. Technically, do you need a raw material inventory posting setup for sales? Not unless you're selling items that are raw material. So really, you might only need it on the finished goods side, but we have our cost of units delivered. This is our receipt. And then our cost of goods sold. So that's our receipt as well for the delivered. And then that gets reversed out when we get invoiced. And then we can choose whatever revenue account we have here. Okay, so in summary, we went over our accounting concepts. Debits equals credits, assets equals liabilities, and equity, and revenue less expenses equals net income. We went through our big three operation processes: purchasing, production, sales. Went through all the T counting in there. And then we went through the configuration necessary for all of those processes. So now we're going to go through a demo and see what this looks like in my system over here. In my demo environment, it's all golf based. So I basically make a golf club. So I have the shaft, the head, the grip. For this one, we have our prices coming in right here. These are all raw materials. I actually don't have to register the item, so I'm just going to go right into product receipt, and we can see what this looks like. Put our receipt number in there for our ordered quantity. Click OK. And one thing I want to note, and this is really helpful, especially when you're working in our demo system, for whatever reason, the vouchers don't like to show up. So this subledger journal entry is not yet transferred. You want to go over here. You'll see once you post a product receipt that the voucher exists right here. Just click transfer now. We'll move it over. Basically what this is doing is it's actually letting it post to the general ledger, the trial balance. So if I look at my voucher for my product receipt, what we can see here is debiting our raw materials inventory and accrediting accrued purchases received on invoice. What I want to point out right here is this posting type. So this tells you directly where this is coming from. If we want to look at our inventory posting, then we can say, okay, well, where is that account coming from? It tells you exactly where. Purchase order, cost, purchase materials received, raw. So it's hitting 140-100, right? Cost of the purchase materials received. That posting type tells you directly what it should be. If you have a confusion about where this is actually posting, you can directly tie it from posting type to the posting profile. That's our asset account. We have our credit, our received not invoice. We have those all set up. So now what we're going to do is we're going to assume we're receiving the invoice from the vendor. We're going to post that invoice. If it wants to play nice here. Put in our invoice number, put in a date, go ahead and post that. One thing I like to do, especially when you're trying to explain this to a client or something like that, or explain to anyone, pull up the vouchers for both of these. And you can access the vouchers from the product receipt, from the purchase order, right? I'm on the purchase order, product receipt, vouchers. My invoice is posted. I have to transfer this over because I don't want to wait. Go to my invoice, go to my voucher. Right now I can see pretty clearly what is the story between these two, right? You can see that my accrued purchases was debited, my raw materials inventory was credited. Those are the same transactions I see on this side. So they get reversed out, right? They get reversed out. That means that just remaining is this raw materials and accounts payable. Those are the final balances for this account. So you can always tie it back through looking at all the vouchers within the process. Okay, moving on to production orders. So I have this release, this production order. It's a BOM that if we take a look at the BOM, it would be just the, I can maybe click into it right here. It's just those 3 items that I just bought. One thing I want to show here is that when we're looking at our managed costs, when we look at our view calculation details, we can see that we have a cost price, right? $50 for that item, $100, $5 that's that 155, right? That's our 155 that we're coming in here too. So when I estimated this, it's saying I think this is going to be 155. And then I have some route that adds cost to the item as well. This is what we're showing here for our costing. But at this time, and I like looking at this production posting, we don't have any transactions. We've only estimated and scheduled, and I released it to the floor as well, actually, but we haven't done our start, which with my start, it's going to just post the picking list and it's going to post that route card automatically. When I go ahead and start this, it has post route card now, post picking list now. So I click on, and then we go back to our production posting. What we have here, right, our first 2 transactions that happen on production posting. So this is the pick. If I look at my voucher, it's picking it from raw materials and it's going into production with materials. This is the start of financial transactions for the production order. And then for the route, same idea, right? We have our direct labor applied. This actually should be a payable. I just forgot to change it, but this is going into our WIP labor as well. You can see everything's estimated, right? At this point, it's not the final cost. It's just what we think it is. So we have our production posting for those 2. And then what we can do now is do our report as finished. So I'm going to hit report as finished. Click OK. We're just producing 1 item here. Go back over to our managed costs and look at our production posting. So now we have this voucher for report as finished. We've produced a finished good item. It exists. It's available in inventory. You can put it on a sales order. That goes in production with materials. To Christian's point, probably should be a WIP finished good material, so it's different than the raw material. And then what we do is we want to end this. And we go ahead and end it. And then we can take a look back at production posting. So the best thing to do right here would be just to see the voucher for each one of these, so you can actually see where it comes through. So I'd have my production order for route consumption. I would have my voucher for report as finished. Everything will produce through this, so you can see how it actually got to the point where we have a ended amount. So that's what we're going to do. This one will be our route. And this one will be our material consumption. So first one, right? We have our pick. It gets reversed. Where is that getting reversed from? We have our production materials, estimated cost of materials, and estimated cost of materials consumed. So those are done. Now we have our direct labor applied and production labor, both the estimated, right? We go over here, say, okay, direct labor applied, and we have our production with labor, the estimated one as well. So those are reversed. Back over here to our report is finished goods inventory, production WIP. Our finished goods inventory, estimated manufacturer costs, and then we have our production WIP as well, right? So everything's been reversed at this point. And then remainder is just those other transactions that come through. So we say, well, our final cost of materials consumed was 155, and that went into production with clearing. And our final our labor was $60, which also going to production with clearing. And then finally that 215, the 60 and 155 in whip clearing gets credited, and then we debit our finished good inventory, which is manufacturer costs. I know this is a lot, but really the only way you can look at it is by going through each one of these and looking at the posting type, looking at your amounts, finding what they are in here, and then marking them off, reconciling them against each other. That's really the only way you can work through it from a production order perspective, or really the other ones as well. Last but not least, we got our sales order. We have already produced our item. Now we're going to go ahead and pick this item, confirm it. So looking at this, right, do we have any financial transactions? We picked it. Is there anything in a physical voucher? No, it's just picked. Nothing in the financial voucher. For sales orders, that's just not the case, right? We need to post our packing slip. So we're going to post our packing slip. We're going to say, yep, we want picked. Go ahead and post that packing slip. By the way, the unit price is $5.45, so we're selling it, right? We're making a profit. Look at our voucher. For whatever reason, the sales goes a little bit faster than the AP. I don't know why. But anyways, that $2.45, that's what the costs actually ended up being, right? So that's what's coming out of finished good inventory. That's our cost of goods sold. Because I already ended it, I know it's going to be the same amount, right? So when I invoice, this is going to be the same amount in which I produced it. Go ahead and invoice this, and we'll see the final transactions. Packing slip, right? Credit to finished goods inventory, debit COGS. Same idea, right? We're going to credit COGS first and reverse that finished goods inventory. And then we get our final amount of what the finished goods inventory is, which represents the same side on the COGS. And then the sale, right? Whatever we sold it for, it just represents what's going to sales and accounts receivable. Any questions? I know we have about 3 minutes left.
Is there anything that, I know you talked about those configurations for demo environments, but what about are there any other configurations you get pinged on often?
Not so much. I think there's a whole nother element of this when you talk about financial dimensions and how that comes across. I've been actually doing some research about what that looks like from like where you can apply financial dimensions to, and how that defaults into a sales order, or how that defaults to a purchase order, how that comes on a production order. I think one key thing, production is obviously just a lot more complicated. One of the key settings that might trip you up from a ledger posting perspective is this item and category. So you have these three options. Item and resource, that might mean like you're choosing your ledger account from the resource, not the cost category. And this is related to your routes, whatever kind of production happens to that. They also have this concept of production groups, which is just a totally different thing with how ledger accounts coming from. But this can be important in terms of where the ledger accounts are being sourced from a production order standpoint.
If your organization is looking to optimize its financial processes, streamline inventory postings, or enhance system configurations in D365, Logan Consulting is here to help. Our team specializes in aligning operational and financial best practices to ensure accurate, efficient, and compliant transactions. For more information or to discuss how we can assist, reach out to Logan Consulting today. We'd be happy to help you execute these processes effectively within your organization.